in the past we've talked about the bull versus the bear market before,
Hmm.
and just straight off the bat, we have a pretty amazing question in from one of our clients asking, since we are at the last stage of the bull market, we are anticipating the end of the bull market at the beginning of a bear market in a couple of years from now. What would you do to prepare for the bear market, and how would you invest our money in this situation in a transition from the bull to bear market?
Yeah, it's a really good question, actually, and there's a whole bunch of layers in there that I'll try to cover. But the first one, and I think probably the most important thing to look at there, he's asking about preparing for a bull market. And so one of the things that you have to think about in terms of preparation for a bull market is just how much stock versus bond that you have in your portfolio. So like the total risk of the portfolio, which is super important. And we have some data going way back to 1926 that's provided by Vanguard that kind of
Wow.
shows for each level, 10% stock and 20% stock, historically, what was the worst 1 year period. And so it kind of gives you an idea for what you're getting involved with in terms of that total risk. So that's one of the ways that we prepare for a downturn of any type, even the smaller ones. And so that's how you kind of can moderate some of the risk in the portfolio. But beyond that, I mean, truly preparing for a downturn is what I call predictive. And what I do is what's called reactive. So, and there's a big difference there. I don't believe you can predict the next bull market. I believe that they will happen, but I don't know when they will happen. There could be one that starts on Monday, or it could be 15 years from now. And so that's the hard part to really tell is like when it's going to happen. So I tend to get the clients into this mixture of stock versus bond. Maybe it's 100% stock, maybe it's 60% stock and 40 bond, or whatever the mixture is. And once we get that, we basically manage the portfolio as if the market's going to continue up, and then we try to react to those downturns. Let me share my screen, and I can show you some different pieces here that I think are, going to be useful. So this is the S&P 500 for the last 25 years, and so each one of these little dash bars here is a month. And so you can see, we had our 2000 downturn, right? We had our 2008 downturn, and we had our, just this pandemic downturn that just happened last year. This was about 40%, about 60%, and here's 35%. And this is actually the fastest 35% downturn in history. But one of the things you have to pay attention to here is that month by month, if you look at this, there are more up months here than there are down months, and there's more upturn altogether. There's only three big downturns that have happened in this 25-year period. And so you have to kind of assume that the market's going up because the probability is that the market is going up. And so that's kind of one of the first things that we always think about is trying to stay invested as much as possible. But then you want to put in some protections over a period of time to try to figure out, what you might do if things do start to go down. Uh, and so some people will just buy and hold, and I have clients that want to do that, and we're fine with that also. You just got to make sure that you understand what that means as far as that goes. But I'll show you what we did in this particular downturn here that just happened in the pandemic. So the first thing that we do is we use these stop losses. So let me pull up a different chart here. So here's Apple for the last 12 months. And so again, every one of these little boxes is a day, right? And this is the 200-day moving average. And this is a very important portion of this chart. This is what's called the volume profile. So this shows, each one of these bars shows how much volume or how many shares essentially were transacted at that particular price. And so you can really see, where things were purchased. This red line shows the highest volume of purchase for the time period for the year. So the first thing I'm going to do here is I'm going to start to put in alerts, and I'll just show you how I do this. So one of the things that is very common within the trading community is this 200-day moving average. And oftentimes when a stock falls through the 200-day moving average, sometimes it'll accelerate down from there. So I'm going to put an alert, really right here, right under this 200-day moving average. I'm not going to respond to that, especially for a company like Apple, but I do want to know that that happened. So there's an alert. I'm going to put a second alert right here at the highest level of volume. And what I'm trying to do here is really identify these areas of high support. So what happened is, if you look throughout this year, more shares were transacted at this price than any other price. And so often when the market comes down and gets to that level, you'll see a bounce. But if it happens to crack through that level, then we've just broken that support. And if you look down here, and this is where I would put my stop loss if I had or at least an alert. I use both alerts or stop losses. Depends on what I'm trying to do here. And so here you see there's basically no volume underneath. So if it gets through here, it could fall all the way down. And that's a fairly big, significant motion. So that's the reactive portion. I'm getting notified when things are happening. And then eventually when it gets down bad enough, I might reduce my position or eliminate that position. And so we did this year when we had the huge run up early in the year and all the clean energy and what have you. We put stop losses in place, and it worked out really, really well. So that's the first piece. And then let's say that something triggers, then what do we do with that money? Well, the first thing I do is I look for, let me pull this chart up. Oops, sorry. I look for positions in the market that are doing better than the market itself. So this purple line right here is the Vanguard Total Stock Market Index. It's the ticker symbol VTI. I love using this because it's essentially every stock in the stock market. And then this line here right now is Apple. Okay, so you can see that Apple fell a lot less during the downturn because this is from the very top on the 19th of February of last year to the very bottom here, which is the 23rd of March. And so it fell a lot less, and then it actually ended up kind of continuing its movement upward. So it was down 10.6% instead of 17. So I like to rotate those pieces that we've freed up with these stock losses into holdings that have fallen less than the market. And the other piece of this that's super critical, it's not just trying to protect how much you lose on the downside. It's actually more important on how fast you bounce back. So I'll give you an example. Let's say you have a portfolio, two options. One where the portfolio would drop 30%, but you'd make your money back in 3 months. And another one where it only drops 3%, but you'd make your money back in 3 years. I would personally take the negative 30 because it comes back that quickly. So it isn't just how much it falls, it's how fast it comes back. And one of the things that I've seen is if you use the data that's coming to you when the market is falling and you start to rotate into those things that are falling less, oftentimes they bounce faster and come back faster. So I got some other examples. And we bought Apple on the 5th of March. We also bought Microsoft on the 5th of March. And you can see great bounce, down 6.8% instead of 17. We also purchased healthcare. Again, huge bounce, down 5.6% basically instead of 17. And these are things that I saw falling less than the market, and we rotated into those. We also bought cybersecurity because everybody was going home, and and that's down 7.5% instead of 17. And we bought genomics. This is iDNA, and that was actually up. And that's huge bounce, right? This actually included Moderna in it, which obviously became something everybody got to know pretty quickly. And so that's a second part of the strategy is just that ability to get into something that is falling less and hope that that bounce is higher and faster and we can recover quickly. Now I didn't buy these up here I bought them in this down time frame here just because I could see that they were falling less than the market, and that's what I'm looking for in downturns. I start scouring through because what I'm seeing is that the market is saying, hey, we still like these things more than the market as a whole. And like for Apple and Microsoft, they have huge cash positions. For this particular one here with this genomics piece, obviously, they have some need for a new vaccine. And so that, the market is automatically telling you, what they're still interested in. And so that's a really big deal. And we did this. These are actual trades that we did during this downturn. And the other thing that we did with some of these pieces that came out of the stop losses and what have you was to move into long-term treasuries. So if you look at this, this is it's called EDV, right? It is a Vanguard Extended Duration Treasury. During times of stress, people fly to treasuries because they're safer. And then usually there's an interest rate decrease by the Federal Reserve in these big downturns. And so that also helps the price. And you can see that this was actually up 19.8%, in the same time frame when the market was down 17. So we will put 5 to 10% of the portfolio into something like this, into these kind of long-term treasuries. So even if we have a 100% stock portfolio, we might go down to 90% stock and 10% long-term treasuries and those types of things. And so this was a strategy that we used very successfully, actually. Then kind of the last piece here really is the ability to use an inverse position. And so an inverse, this is pro shares, and this goes in the exact opposite direction of the S&P 500. So if you look at this run right here, it's up 40% from that point that it starts, and the market's down 35. So it goes the exact opposite direction of the S&P 500. And so that's another piece. But then you can also see as the market recovers, right, it starts to go down, unlike what you saw with the Treasuries. So we didn't actually use this during the downturn, during the pandemic downturn in February or March of last year, mainly because it was just so fast. Because we kind of go step by step. First we have the stop losses, and then we're rotating into stocks that fell less, and then we're moving into things, like the extended duration treasuries. And then we would have used this, if it would have continued to be a problem, we would have started to use some inverse. We're not actually looking to make money in a downturn on the stock market portion. We're just trying to slow down some of the descent. And by slowing down the descent, what we're doing is really trying to get the recovery to come back faster. And so everybody has to take a certain amount of risk in their portfolio because we can't predict when these things are going to happen, but we're going to, make these step-by-step changes throughout these downturns. So I don't prepare a portfolio for a downturn in advance. That's predictive. I do a reactive scenario where I go through these steps. And these are steps that I've defined and honed and worked on for, my 35-year career. And it worked great. I mean, we did really, really well here, and our bounce was very strong. We came back much faster than the market across the board. And we did the same thing with the ESG portfolios. There's a lot of different pieces there that we can look at too. So really, that's the answer to that question. It's obviously kind of a long answer for a short question, but it's probably one of the most important things that we do is that process and kind of what we've learned there as far as that goes. Then you got to go the other side, which is how to unwind all of those things. How do you unwind the treasury pieces and get back? And how do you unwind, if you have an inverse, how do you unwind that? How do you get rid of it and go back to the market? Which is a whole nother subject. But anyway, those are the basics for how it works as far as that goes.